I'm going to answer the question about why I think people should have multiple retirement accounts. And when I say multiple, I don't mean just like more than one. I mean different types of retirement accounts. And primarily the two types of retirement account we could talk about are traditional IRAs and Roth IRAs. Or also, if you participate in a 401k at your job, you probably have what's called the traditional option of the 401k or the Roth version of the 401k. Quick rundown of difference between traditional and Roth. Traditional is such that you make money, you don't pay taxes on it today, and you that happens by way of a tax deduction. You deposit the money in the account, the money grows tax free, but you pay tax on the withdrawals once you qualify to start taking withdrawals from the account. With the Roth, you make money, you pay tax on it today, you put it in the account, it grows tax free, but when you start to withdraw the money, you don't pay tax then. Being able to make a decision about which of these accounts to use at any given time can be beneficial. So in your high income earning years, you're going to be in a higher tax bracket, right? So if you get all the way up to the 35% tax bracket federally and you live in an expensive tax state like California, you're going to be paying the equivalent of about 45% in tax on your highest, the top part of your income. So if you take money and you put it in a traditional IRA, you're going to get a tax deduction in that highest tax bracket. So for every $1,000 you put in, you get $450 of tax savings. That's a good thing. That's probably a reason why you want to go with the traditional versus the Roth. Conversely, if you happen to have a low income year, and you're not going to be in a high tax bracket, but you still want to put money in a retirement account, you might go with the Roth because today you're not going to be paying that much tax on it. And down the road, when you do the withdrawal, you're going to get those withdrawals tax free. So you might make the calculation that it's better to put money in the Roth today versus the traditional based on how much you're making in a year, what state you're living in at the time, and what your potential tax savings is going to be today on the traditional. Now, here's yet another idea, though, that you can utilize having both types of accounts. Say you put a bunch of money in your traditional over time, and you've amassed a certain amount of contributions, and then say, I don't know, one year you take a sabbatical, or God forbid you lose your job and you have no income. You can do what's called a Roth conversion. You can take money from your traditional IRA and put it in the Roth. When you do that, in the year that you do that, you are essentially creating taxable income because the IRS is saying, hey, wait, you didn't pay tax on this money when you put it in this account. Now you're going to go put it in this other account where you should have paid, you have to pay tax prior to the deposit. So if you want to move money from here over to here, we're going to give you a 1099 saying you made this much extra income by doing this transfer. You literally will get a 1099. So say you transfer $10,000 worth of stock or $10,000 of cash, you'll get a 1099 for that tax year saying you made $10,000 of income. Let's say, for example, though, you and your spouse have no income for the year. Well, if you know a little bit about taxes, you know that at least in 2023, you get a standard personal deduction of almost $13,000. So between you and your spouse, you get a combined ability to make $26,000 and pay no tax. So if you didn't make any other money in the year, you could convert $26,000 of money from your traditional IRA to your Roth IRA and pay no tax on it. You're technically making the money taxable, but because you haven't reached your personal standard deduction, you're not effectively going to pay any tax on it. So what you now have done is you've taken money that you've paid no tax on at the beginning, and when you put it in your traditional, you've transferred it to the Roth in a time period where you knew it was going to be tax favorable, and now you're not going to pay any tax after withdrawal because it's now in a Roth account, and those are the rules for the Roth. So you've effectively used time in your situation to create the most tax efficiency for these retirement funds. So I've done this in years, a couple of years ago, I wasn't working as much and didn't make as much money, and I took the opportunity to do a Roth conversion. It so happened that some of the stock that I was in at the time was down because it was like at the end of 2021. So I was like, hey, I'm going to get the tax efficiency, but also I'm going to do a transfer when this stock value is lower. I didn't actually sell the stock, I just moved the stock from one account to the other. At the time of doing that, the value that was assessed to me was based on the stock price at the time. The stock price has since recovered, being, in the Roth account, and I wasn't planning on selling it anyway. So I almost got like a double efficiency in that scenario. So that's another thing that you can look out for. So that's one prime, or those are a couple prime reasons why you'd want to have a couple different flavors of retirement accounts. So there you go. Just answering that question. Have a good one. Bye.